Many Bitcoin treasury companies don't have any revenue, they don't have any income. And when it comes to sustainability, because there is the Bitcoin volatility, how you can keep accumulating, how you are not forced to sell because there is some kind of drop down in the price of Bitcoin. How do you think about this sustainability kind of theme for a corporation that is listed, that has got shareholders, that have got listing costs?
If I told you there is no chance that we will ever underperform Bitcoin under any scenario, that doesn't exist. I wish it did. We're very smart financial engineers, but we're not magicians. And there is a risk, and say that the risk is a 6 to 10 year bear market for Bitcoin. That'll be a scenario where likely you would have been better off holding Bitcoin. But then I guess the question is, Bitcoin goes into a 6 to 10 year bear market. How does your Bitcoin investment itself do? It gets crushed to the point that you probably could just through, working a job, buy back Bitcoin during that 6 to 10 year bear market. So I think we feel very comfortable that that's a risk worth taking, a risk worth, being very clear about. And, as a Bitcoiner, if that happens, like if Bitcoin goes down to $20,000 and it stays down there for the next 10 years, I don't think that's a risk that anyone feels is very likely as a Bitcoiner.
Welcome back to the Financial Fox. I'm your host, Steffi, and every week I bring to you some interesting conversation that I had with founders, CEO, investors, and experts about Bitcoin and crypto. Today on the show, we are going to talk about Bitcoin Treasuries. And joining me is Matt Cole, CEO of NASDAQ-listed Strive. If you want to build generational wealth, then you want to invest in assets, real estate, gold, and Bitcoin, assets that appreciate over time. And that's why I think it's so important to talk about Bitcoin treasury companies, what they are doing with their strategy and how they are revolutionizing capital market, but also investment opportunities for their shareholders. So we are going to dive deep into all of that with Matt. But before we do it, I want to ask you a favor. First of all, if you are watching the show on your preferred platform, please take a moment to subscribe to our YouTube channel, follow us on LinkedIn or X, and give us some love. Do a like. Remember that your support is so important to grow the channel so we can educate more people about Bitcoin. So take a moment to do that. And finally, remember that all the content on the show is for informational purposes only, and we don't offer financial advice. So make sure that you do your own research, level up your skills, and be accountable for your own decisions. And finally, a big thank you to Hive Digital Technologies, our partner and sponsor. Hive is one of the fastest growing publicly listed Bitcoin miners and data centers operators. Ticker is Hive, listed in Canada, NASDAQ, and Frankfurt. They operate data centers in Canada, Sweden, and Paraguay. And very important, they are empowered entirely by green energy. Their priority is to build and scale a lean, shareholders-focused company that also transforms the community where they operate. 2025 has been a strong year for Hive. They just hit 25 exahash, and their subsidiary, Buzz HPC, that specifically focus on AI cutting-edge solutions, has been delivering some amazing partnerships in Canada with a focus on sovereign AI. If you want to know more, visit hivedigitaltechnologies.com, and for their AI company is buzzhpc.ai. Now, back to the show. Hi, Matt. How are you doing?
Good, Steffi. How are you?
I'm good, thank you. It's great to have you on the show, especially in this point of time where there are so many investors questioning the Bitcoin treasury strategy, which obviously has been a big theme of 2025. And here in the UK as well, obviously, in the US has been stronger, but I think globally has been a kind of a revolutionary way to think about exposure that corporation can have on alternative assets. So thank you for coming on. And maybe we can start with that for people that don't know about Strive. Maybe you could give us like a 3 minutes pitch.
Yeah, absolutely. So Strive is a Bitcoin treasury company. Our core business is asset management. So we have about 13 ETFs, but from a investor perspective in our company, what you should care about is our Bitcoin treasury strategy. So right now we have over 7,000 Bitcoin, and then we have amplification through perpetual preferred equity. So we IPO'd a preferred equity last week called SETA, which is similar to Stretch by strategy, but with a few different investor protections that we were able to add into it. And so we are the first Bitcoin treasury company with amplification through preferred equity only. And our belief is that preferred equity is the ideal form of amplification. It's not actually leverage because it's not debt, but you could think about it like leverage in the fact that it amplifies Bitcoin's returns for our common equities. You'll see that in upward markets and also downward markets, that our stock should trade like amplified Bitcoin. And our belief is that over the long run, Bitcoin will never stop going up because they're never going to stop printing money, that we have a debt crisis in this country, and that Bitcoin itself has never had a 4-year period with a negative return in its history. But within those 4-year periods, there's been substantial volatility, both upwards and downwards. And so as a Bitcoin treasury company, our goal and our mandate is to be able to ride out that volatility and outperform over the long run, right? You would expect a Bitcoin treasury company to have, if it's true to its word of providing amplified Bitcoin exposure, to have years when Bitcoin goes up that the Bitcoin treasury company performs amazingly well, and then years when Bitcoin goes down that it's gonna not perform well. That's actually by design. It's a feature, not a bug. And our belief is that if you're willing to hold these instruments for a period of, call it 4 to 8 years, that it's very likely to have a very good return if Bitcoin's returns are what we think they'll be.
And also, a few months back, you have completed the acquisition of Semler Scientific. That being, obviously, they were one of the earliest Bitcoin treasury strategy. They also had a healthcare business. So maybe you want to tell us a little bit about that, why, what opportunity you have seen, and then also maybe your thoughts on this consolidation kind of theme that we have been talking about as the MNAV contract, or has been contracting because of the Bitcoin volatility.
Yeah, so in September, we announced a definitive agreement to acquire Semler Scientific. We expect it to go to a shareholder vote no later than March 2026. That's what's called the outside date, meaning the latest date that vote could happen. But sometime between now and then, it'll go to a vote. We're very optimistic on the vote being a successful one. Strive already delivered a vote in favor of the transaction, but the Semler shareholders actually still need to vote on the transaction to actually push it through. And our belief is that it's a win-win for both companies. I think on Strive's side, we've already established what I think is the ideal corporate structure that we just talked about of amplification 100% through preferred equity. It is our primary differentiator at this point, and I think it's a sustainable one. You look at MicroStrategy as an example, and they want to get to the corporate structure that Strive has. They obviously have X almost more Bitcoin than Strive, so we're not competing on who's going to have the most Bitcoin. It's more of who has a structure that's designed to better amplify Bitcoin's exposure in bull markets. And that's what we think we have the ideal structure in the space. And for players like Semler, they would look to us as a leader in that. And by teaming up, we're able to increase our Bitcoin stack. And so there's kind of an ideal size to run a Bitcoin treasury company. With amplification, I think it's probably a little bit larger than what we currently have at Strive right now. And so this transaction with Semler would help us get there faster. And for the Semler shareholders, get them to a size where they could actually also play a part of that ideal structure with Strive. So that's the primary part of it. The secondary part is that the Semler operating business, their preventative healthcare business, our co-founder Vivek Ramaswamy also has expertise in that space, and we're able to kind of leverage people around Strive to provide some value there. But as a Bitcoin Treasury company, it likely wouldn't sit long term within our company. We'd likely look to monetize that and basically buy additional Bitcoin with it, because our view is Bitcoin's the hurdle rate. And while that business is, actually a pretty interesting business, has an interesting cash flow to it, in our view, likely won't meet the hurdle rate of Bitcoin. But there are a lot of other investors that we do think that would, be interesting to. So we'd likely monetize it in some way and remain, laser focused within Strive on our Bitcoin strategy.
Right, interesting. Obviously, there are different ways. I mean, you could IPO the company separately or could be acquired. Now, let's stay on the topic of Bitcoin Treasury, because I do have a question that might be kind of like a provocative one, but I really would like you to kind of share with us your thoughts. So when we think about Treasury strategy, we think about something that is sustainable over time. So kind of sustainability has been a kind of one of the theme of my thesis around Bitcoin Treasury strategy. One of the aspects that I'm kind of like not struggle to kind of see how it can keep going on and on is obviously the volatility of Bitcoin. So as a Bitcoin Treasury company, you are not producing any revenue, right? So
not substantial. So we do have revenue, but I would say you could ignore it for the purposes of this conversation, right? Like, let's look at the Bitcoin Treasury. Yeah.
We can also like think about the broader market and not specifically about Strive, but many Bitcoin Treasury companies don't have any revenue, they don't have any income. And when it comes to sustainability, because there is the Bitcoin volatility, how you can keep accumulating, how you are not forced to sell because there is some kind of drop down in the price of Bitcoin. How do you think about this sustainability kind of theme for a corporation that is listed, has got shareholders, that got listing cost?
Yeah, so I think you have to first start with assumptions. And when I mean assumptions, I don't mean like one assumption, but what do you think the future return of Bitcoin will be? So you have to underwrite Bitcoin risk. Okay, that's literally step one. And so I don't know if you have a view on that. Our view is that Bitcoin over the next 10 to 20 years will average a 30% CAGR plus on average. And within that, we'll have substantial volatility. Okay, so when you put that into a Monte Carlo simulation, let's say you just run thousands of different scenarios with a base of around a 30% average rate of return over the next 10 to 20 years, what you'll see is that you really need to be able to underwrite and survive, call it around 4-year downturn risk. And so, what risk we're comfortable taking would be that if Bitcoin goes in a 10-year bear market, that is a scenario where we would likely have to sell a lot of Bitcoin. Okay, there's no getting around that. Strategy would as well. I think some other Bitcoin Treasury companies, given some of the debt terms they've taken, would likely actually fail. But as a Bitcoin bull, you say, okay, I'm willing to underwrite the fact that I do not think there's a high likelihood at all that there's going to be a 10-year bear market. But I do think that there could be a 1 year, a 2 year, a 3 year, or a 4 year bear market. Okay, and say, can I survive that? And how would I survive that, right? And so when you look at Bitcoin's history, what you'll see is that in bear markets, from call it the peak, call it 2017 or 2021, the peak to the bottom and then back up to the peak again, how long did that take? It typically is 3 years. So we think about Bitcoin oftentimes in 4-year cycles, but 4 years includes the bull market that goes up to new highs, right? So call it like a 2-3 year period of downturn. So what we've done is we said, okay, well, right now we have about 25% amplification. So call it 25% of our Bitcoin is backed by the preferred equity, okay? The interest rate on the preferred is 12%. Okay, so what that means is that 25% of 12 means that at any given year right now, about 3% of our balance sheet is needed to pay the interest reserves. So, there's different ways that we could do that. Right now, we have a 12-month dividend reserve already in cash. So for the next 12 months, we can just use cash we already have on hand. After that, we could consider other things. So right now we haven't deployed option strategies, but options could easily generate a 3% yield very easily on your Bitcoin annually. So that's another way that we could cover it. And then ultimately, we also have the backstop of selling Bitcoin. If our stock is trading at a premium to our Bitcoin holdings, we could sell our common stock through the ATM. So the bottom line is let's just take, this is not a base case scenario, but let's just take a worst case scenario right now that, we had to pay, we have a year of cash and we needed to cover an additional 2 years in a bear market. Okay, so we had to sell 5% of our Bitcoin stack and we made it through. And then we're riding the next Bitcoin bull market with amplified Bitcoin exposure. That's not actually a disaster. It would be, a scenario that we're trying to do everything to avoid. We think we have in place several different mechanisms to try to avoid that. But in a downward scenario, if a company had to sell 5%, frankly, even 10% of its assets to meet its liabilities over, a bear market, I don't think that is a disaster scenario for Bitcoin treasury companies. And I think what some people would think is that they're going to blow up. And what you'll see is that for companies like Strategy or Strive, given the preferred equity nature, that there is no maturity risk, there is no encumbered Bitcoin, there is no margin calls. Bitcoin could literally go to $1 tomorrow and Strive would totally be fine. Strategy would be fine. Obviously, people on an individual level that have borrowed against their Bitcoin that have margins, they would blow up. But the question is, we want to be able to ride out the duration while still underwriting Bitcoin and taking amplified Bitcoin risk because we think Bitcoin is going to go up.
Bitcoin yield. So not as appreciation of the assets, but more as actually generating revenue from the Bitcoin. Is that something that you have been considering, you will be willing to do? Obviously involve risk, but it's definitely something that is a solution to generate that cash that you could need in the future.
Yeah, we want to first prioritize keeping our Bitcoin unencumbered. So keeping it completely free in cold storage in our hands and not pledged, not in the hands of other individuals to generate yield off of. We think that introduces new layers of risk for a Bitcoin treasury company. And so I think, when we talk about yield, I think sometimes yield gets different definitions. And when you actually peel back the onion, it could be debatable if it's actually yield or if it's something else, some form of, and when I say something else, I don't mean a Ponzi, I just mean some form of risk to generate a cash flow, right? That you can debate whether you like that or not. And I think what we feel very comfortable in is the strength of the balance sheet of pure play Bitcoin treasury companies with unencumbered Bitcoin and no margin is actually underrated and I would say misunderstood. And I think the reason is that the mental models for most people is traditional companies. And so for a traditional company, you're used to generating cash flow by taking future risk and paying liabilities. But if you take Strategy as an example, if you bring it down to the level of an individual, I said, hey, imagine that, Steffi, you have $1 million in your bank and you want to take out a $10,000 loan. Do you think that you could pay back that $10,000? Hopefully you could pay it back by doing something in the future that provides value. But the fact that you have $1 million in the bank means that you're not really at risk of going bankrupt. And that's Strategy's balance sheet today. Strive is similar, but has a little bit more leverage. So maybe in our example, maybe it's $1 million and you borrow $25,000. That these companies are very hard to break, but not all companies are created equal. And I think that some of them took some bad debt terms. And so as an example, if you look at some, you would see that they have to pledge Bitcoin as collateral. And if they borrowed $100 million, they have to actually pledge $200 million of Bitcoin. And if Bitcoin goes down, they have to keep that margin maintained. And so they could be in a doom loop scenario where they have to start liquidating Bitcoin at low prices. And so I do think that that's a risk for some. It's why we didn't take any debt. We didn't like the terms. So I don't think it's a one size fits all across the space. But I do think that there is some innovative structures that properly match the duration of Bitcoin and its return history with ability to amplify the exposure.
You talk about the cycle, the 4-year cycle that has been playing for many years. I mean, always tied up with the halving, and it was kind of quite consistent with his, with his repetition. Now, obviously, we have got support from regulators, let's say, especially in the US, maybe a little bit less in the UK, in Europe, but it's definitely changing. And then we have got big institutional adoption. How do you see this cycle changing? Maybe staying. Some people even thought it's not going to be a cycle anymore.
Yeah, so I think the beginning of institutional adoption of Bitcoin that we're seeing on several different dimensions, you're seeing sovereign nations buying Bitcoin, you're seeing pension funds, endowments buying Bitcoin, you see a new one practically every week that are major institutions. I think the most recent one is Saudi Harvard Endowment bought a pretty large stake in Bitcoin. Then you see the ETFs and allowing people to get Bitcoin exposure in their retirement accounts. And there are just so many different pools of money that have never had the ability to buy Bitcoin that are now starting to get the ability to buy Bitcoin. That is a different kind of bid. That is a bid that's going to be more persistent. That's going to, as we open new doors, bring in large pools of capital. Then you add in corporate balance sheets like Strategy and like Strive and others buying Bitcoin. And I think that likely does reduce the volatility of Bitcoin. And I think that the 4-year cycle has worked the last few past in history, but I don't know that it has to in the future. But there's clearly a lot of people that believe in it. Right now, as we're recording this, Bitcoin is 90,000 down from its highs of around 125,000, and I think there's a lot of fear in the market. And I'd say, look, like there's a tail risk scenario that this 4-year cycle plays out again, right? And that we go down and then we ultimately come back up again. And that's not my base case, but I think it's a scenario, and that's why though we're not underwriting what we think Bitcoin will do over the next 2 years. That's just not the game we're playing. We're underwriting what we think it does over the next 5, 10, 15, 20 years, right? And so if Bitcoin goes down to 60,000, 70,000, whatever, like we're going to be fine. It's obviously we all hope it goes up, and that's our base case, is that 2026 is going to be a great year for Bitcoin. But we have more confidence the more you zoom out, the higher our confidence is in Bitcoin. And I think that the structural bid from institutions will dampen volatility. And it's not uncommon as an asset matures, whether it's a stock or an asset like Bitcoin, for it to go on a decade-long bull run, right? Like in its history. And I think that at some point, I think we're going to see that with Bitcoin. It might be now, it might be in a couple of years from now, but I think that is coming with the institutional adoption.
What is sending Bitcoin down so much? What has happened over the last few weeks? What are the indicators that you are seeing that you believe are actually moving the needle when it comes to Bitcoin price?
That's a little tough one to answer, but I think we definitely have over the last 6 months seen a lot of long-term Bitcoin holders taking profits. I think that Jordy Visser had a pretty good article on this where he was talking about it being Bitcoin's IPO moment, right? And that distribution from long-term holders, call it the idealists, the hardcore libertarians, into more of the institutions that maybe are more interested in Bitcoin as a hedge on monetary debasement. That is a similar in some ways to the OG Bitcoin movement, but also different, right? Because the OG Bitcoin movement was an opt-out from the system. It was about, obviously like privacy not being part of the system, and now the system's buying it. And so there's a movement of coins, and that could take, it could take who knows how long. It could take 6 months, it could take 2 years, it could take 3 years to kind of distribute. But that distribution is actually a good thing because it actually decentralizes further the holdings of Bitcoin. And I think it, ultimately establishes a base for which we move higher. So that's probably the main one. I think that there's been continued concern around quantum risk. Ultimately, I think that is something that needs to be taken very seriously, and there's still more work to be done on, but I think will be worked through. But it's a big risk. It reminds me, in 2017, the most common big risk was China banning Bitcoin, and they'd banned Bitcoin like 20 times, right? And every time they would, Bitcoin would go down, and So I think that there's these different fear, and that one's kind of silly that a communist nation would ban Bitcoin and it would result in a freedom money, dying. Quantum risk is a serious risk. It's one I think that's we're able to work through, but it is serious, right? OG Bitcoin selling, that is big supply, but big supply is being met with big demand. And so I just think we're in a scenario with a lot of fear in it right now, and nothing solves fear like, the number go up, but that might take a little bit of time.
I'm glad that you mentioned about quantum, because when I speak to different people, especially, the CEO of public listed Bitcoin treasury company, they kind of push it away. Oh yeah, but it's 10 years away. They kind of like don't talk about it as it was a real threat, but I'm glad that you brought it up. And that doesn't mean that we kind of fix it. Obviously the community will do everything that can be done to fix it, and we will be fine, exactly like China, but it's definitely something that we should talk about. The irony is actually more adoption is all down to us, is all down to companies like Strive to keep, talking about Bitcoin and why is a great asset. Now, I want to ask you about digital credit, because obviously Bitcoin, digital capital, digital gold, people get that. Digital credit, are we ready for it? Do you see demand from investors? They are maybe investing in your stock. What do you see from your side? And how different is? Just give us, also a short overview that is always good for who is watching.
Yeah, so digital credit is really the build out of what I would call structured Bitcoin. And so my background prior to Strive, I worked in fixed income and I ran a $70 billion fixed income portfolio. The vast majority of it was structured credit, so called like mortgage-backed securities. And what's been done in the history of finance very successfully, actually. I mean, obviously the great financial crisis being what happens when it goes wrong, but it's taking an asset and then slicing and dicing it to better meet the risk and return requirements of different people, right? So different people are in different stages of their life. They have different demands for different types of risk. And so you take a pristine asset, Bitcoin, and if you slice it and dice it, what you can do is, on one hand, you have Bitcoin treasury companies' common equity. So like Strive and Strategy, that's designed to trade like amplified Bitcoin. So you're basically putting more volatility than Bitcoin in the common equity. And the converse then is, where are you putting less volatility? Where are you stripping down volatility? And that's digital credit. So taking Bitcoin, which we both agree, and I'm guessing most of your listeners agree, is going to go up over the long run, but saying, hey, this is a volatile asset. Maybe your grandpa can't handle the volatility. Maybe your grandpa can't understand it, but they do understand cash flow. They're a real estate investor, and you go to them and say, hey, you're used to investing in real estate, getting a cap rate on your real estate investment of, call it 6%, with a lot of work, a lot of sweat. What if instead you bought digital credit and you had a volatility profile that was maybe similar to the real estate, but instead you were earning 10% or 12% on your money, and your money was tax deferred? It was return on capital. Would you be interested in something? You look at like Stretch or SETA as an example. Stretch is down right now. It's 95, but it was at 100, so it's down 5%. Like, think about Bitcoin is down 30%, Stretch is down 5%. So substantially less volatility, right, than the underlying asset, and yielding 10 to 12% in a risk-reduced manner. Is that interesting to people? Yes. I guarantee you that's interesting to a lot of people that are in retirement, nearing retirement, that want cash flows, that maybe don't fully understand Bitcoin, but do understand yield and are able to take some volatility. That's a extremely interesting product. And I guess just to give you a sense of demand. So when we IPO'd SETA, we initially publicly said we were going to raise 125 million. We upsized it from 125 to 200. At 200, we were still 2 times oversubscribed, meaning that there was 400 million notional of demand for SETA, right? Substantial demand. Even since then, we've had people wanting mass blocks of SETA. And so what you're seeing is that there's a lot of demand for digital credit. It's traded up from 80. Right now it's at 91. I think it hit 95 at some point. So it's done really well since the IPO just over a week ago. And so I think there's a lot of demand for less volatility, high yield but with Bitcoin backed risk. And so I think that you can find your investors. Some investors want less volatility than Bitcoin. Some just want to own Bitcoin. Some want amplified Bitcoin. And there's going to be demand for all of those different instruments. And I think that is part of the innovation that Bitcoin treasury companies are bringing to the Bitcoin ecosystem.
And when you are talking about investors that you are talking to or they've been investing in your preferred, are you talking about like traditional financial US institution or really kind of like investor they actually are Bitcoin and understand Bitcoin? So who is actually backing the stock and the product?
All of the above. So there was strong institutional demand. Some of it was asset managers, so long-term holders. Some of it was shorter-term, call it more fast money accounts. Some of it was, like family offices, financial advisors putting it in their accounts of everyday citizens. And then some of it was just retail investors that wanted it. I know several examples of traditional real estate investors that like the yield profile of SATA. Some of it just people in retirement that love the yield profile. Some of it was people that are just Bitcoiners that say, you know what, I'm super comfortable underwriting Bitcoin risk. This, I have a bunch of cash that just is kind of like my safety account. I'm going to actually put it in SATA or Stretch and earn some yield on it. It's really all of the above actually, which I think makes sense. I mean we're emerging out of a system that sold people a 60-40 portfolio, where 40% of people's portfolio was fixed income that yielded nothing in the midst of a debt crisis. And so this is a great solution to that part of the portfolios of many people that's trillions and trillions of dollars. And so ultimately, I guess just to round this point out, when you expand the buyer base for a core asset in Bitcoin by providing different products, you ultimately expand the demand for Bitcoin. And so I think that ultimately will help it go up pretty substantially as people are able to get it in the form that best meets their risk and return objectives.
100%. And I think, one of the, if I just go back to the way kind of like I think about risk, right? When you have got lots of fears, you convert some of your digital assets into stablecoin. That's what we have all done in the previous cycle, right? You start on your stablecoin when things start to kind of see they're moving up, you go back in, right? And perhaps getting exposure to preferred could be a way to kind of de-risk without getting out of the industry. Rather than putting money in stablecoin, you could buy digital credit. I mean, that's the way that I have been thinking about it. I want less risk, so then I go, but I stay within the Bitcoin space.
Yeah, that's exactly right. And I think that as people understand better the balance sheets of Bitcoin treasury companies, I think that'll be more and more an accepted way to think about allocating within the ecosystem. And just to give you a sense of how early we are, when S&P rated Strategy B-, within their rating, they gave them literally zero credit for their Bitcoin. So they rated them B- as if they held zero Bitcoin, right? And it's really easy to talk to institutional investors and pick that apart and say, look, can't you agree that the fact that they have name your $60-70 billion of Bitcoin, can't you agree that makes them more credit worthy, that it means something? And I was like, yeah, of course. Okay, then you would agree that S&P underrated Strategy because that would improve their credit profile. Okay, like that makes sense. Okay, well then if they were B- with no credit, what do you think they are? Investment grade has to be the answer. And then how high on the ladder they are in investment grade is to be debated. And my view is that they're actually A-rated or AAA rated because the balance sheet is so strong. Like when we gave that analogy earlier of you have $1 million and you borrowed 10,000, like what are the chances you can't pay back your $10,000? It's so small that it's hard not to view them as nearly unbreakable on the credit side. And then on the equity side, it's going to be volatile Bitcoin, right? That's what you should want if you're a super Bitcoin bull over the long run, is the ability to even outperform Bitcoin itself.
So Strategy has quite a few preferred where you have one, and if I understand correctly, you are not planning to have more.
At least not for the next 12 months. And so our view for us is that less products is better. It's not the primary objective. The primary objective for us will be to maintain the amplification profile that we want for our common equity. And in an ideal scenario, we're able to do that with just SATA. There's a chance that we grow so quickly that we need multiples, and well, at least for the next year, just have SATA. But there's a chance that happens. I think with regards to strategy, they're under levered. They have so much Bitcoin. They had so much success so quickly that people think that the risk with strategies that they blow up. I think strategy's view would be our risk is that we actually have to grow the digital credit market tens and tens of billions of dollars to get the amplification profile that we want. They're going, to Europe, to foreign nations, different products to meet different investor demand, ultimately to, get their amplification profile that they want. The nice thing is that also for investors provides a bunch of different preferred equities that have different risk return profiles. And so it's a great service. I think for Strive, I think there's beauty in simplicity, and if we can just have two, I think that's ideal. But time will tell if we're going to need another one or not.
I agree with you on the simplicity side, because especially when you're talking to investors, if they see too much choice, sometimes, I'm not saying always, and also depends who are you talking to, but when there is too much offering, then there is confusion, and then they don't know what to do. So they need to be advised in a way, but simplicity can be actually a strong point. Now, you talk about amplification. Can you tell us how do you think about amplification and the metrics that you're working within for Strive?
Yeah, so I think somewhere between a 25 to 50% amplification ratio will be our long-term target. And likely not working towards the higher end of that range anytime soon. But the way I think about it is, do we have the structure in place to comfortably be able to say that we can ride out a normal market cycle of Bitcoin? Yes or no? And so to the extent that we pushed amplification up to the higher end of the range that I'm talking about, you would likely see us also announce some form of downside tail risk protection, right? So that way we could feel comfortable that in a downturn that we would be able to ride it out. So one of the things that we talked about in the SATA deck was potentially instituting at some point a tail risk hedge. And so tail risk hedges can work in the sense that you're basically, it's not a defensive strategy where, like, if you had no leverage, you would never put on a tail risk hedge. But if you have enough amplification through preferred equity, then you might say, I want, if Bitcoin goes down 50%, I want a tail risk hedge that would provide enough, of a payoff to meet 2 years, 3 years, or 4 years of cash payments for my preferred equity, right? Then you say, look, like, if Bitcoin goes up, then that insurance policy is just something we pay, right? But if it goes down, we have built into our structure something that'll likely cover our interest payments to be able to ride out a normal downturn, right? With still saying, at some point, at a certain, period of downturn, we likely would have to sell Bitcoin, like we talked about. Maybe it's, 5 years, 6 years, 10 years, depending on, the different types of structures that we could put in place. But, being able to ride out a normal downturn and then saying, for any business, you're willing to underwrite a risk. And I think sometimes where people struggle is being able to clearly define when the strategy likely won't work. And when I say don't work, I don't mean blow up. I just mean, underperform, Bitcoin. And I think that there always is an answer to that question, right? Like, if I told you there is no chance that we will ever underperform Bitcoin under any scenario, that doesn't exist. I wish it did. We're very smart financial engineers, but we're not magicians, right? And there is a risk, and say that the risk, like, is a 6 to 10 year bear market for Bitcoin. That'll be a scenario where likely you would have been better off holding Bitcoin. But then I guess the question is, Bitcoin goes into a 6 to 10 year bear market. How does your Bitcoin investment itself do? Like, it gets crushed to the point that you probably could just through, working a job, buy back Bitcoin during that 6 to 10 year bear market. So I think we feel very comfortable that that's a risk worth taking, a risk worth, being very clear about. And as a Bitcoiner, if that happens, like if Bitcoin goes down to $20,000 and it stays down there for the next 10 years, I don't think that's a risk that anyone feels is very likely as a Bitcoiner.
Yeah, definitely. I mean, there is always the risk, let's say, that something bad happens, but obviously it's not something that I believe as well. Now, if there is anything that you would like to do with Strive that is at the edge of innovation. Obviously, we talk about digital credit, which is what you are doing. You come from a financial background, Bitcoin Treasury company, are financial companies. Is there anything else that you are thinking about doing, or you think that would be interesting for corporation to kind of integrate in their strategy?
Yeah, I could come up with 100 ideas, but I think that for us, the most likely answer for almost all of them is to say no. And I'll give you a couple examples, but in traditional hedge fund space, how many different hedge funds are there out there? There's thousands of hedge funds. They all have different theses. Some of them work, some of them don't. Many more than one work, right? Like a lot of them end up working, but the question becomes, what are you focused on? And our focus has become digital credit, right? That is our laser focus as a company. And I think that there's going to be many other Bitcoin treasury companies that actually have interesting focuses on different ways to think about Bitcoin as risk. I think some of the version ones of Bitcoin treasury companies, I think, really struggled to define a differentiator other than, we are, something surface level as a Bitcoin treasury company. And I think that's where you're seeing some MNAVs compress. And I think to come out of that, there's going to need to be for them a legitimate differentiator that's interesting, that provides the ability to provide some form of interesting risk-adjusted return. And I think that's kind of where we are. And I think that's why there's room for consolidation in the space, is that some don't have the teams or just were unable to find a differentiator. I'll just give you an example of one that I don't like, because we weren't going to do it, but I actually think that investors would like. And that's around covered call writing strategies. And so if you look in traditional fund space, there is hundreds of billions of dollars of demand for covered call strategies because of the income that they produce. They're very popular. So a covered call strategy around a Bitcoin treasury company, I think, would actually have a lot of demand. I don't like it. Why do I not like it? Because I know that, from traditional fund space, that the total returns of covered call strategies underperform just the actual asset itself. So if you look at an S&P 500 covered call strategy, it underperforms the S&P 500 from a total return perspective, right? That we are ultimately at Strive trying to drive total return. We're total return, not income focused for our common equity. But that's not to say that others have a different viewpoint. And I think that is a product that should exist. It's kind of almost like the anti-Strive, right? Like Strive is focused on total return. Another company is going to be focused on income. Like other companies might be pairing real estate investments with Bitcoin and talking about how the income provides a diversification hedge and tax benefits. And look, like I think there will be demand for it. It's not going to be our focal point, but it shows when you start thinking about structural differences like that, how you could see a lot of different Bitcoin treasury companies have different pitches that would appeal to different investors versus just, we're the Bitcoin treasury company of Europe, or we're the energy company that's a Bitcoin treasury company, or we are, name your surface level differentiation that from a risk perspective probably is less interesting than strategy itself, right? Like for Strive to say, for us to be able to say, we have the structure in place that strategy wants to get to by 2028, 2029. Like we're the only one that's there. That's interesting. I think there's a lot of demand for that. And I think there's a lot of interesting ways to think about innovation in the space. And probably, the more that we're, sitting around, 100K or less, probably the more you're going to start to see more focus on income strategies, would be my guess, because of the fear in the market, right? That fear will breed a desire for people to over lever to insurance. And then bull markets, the door the door will not be big enough for, amplification. And so that's kind of, I think, what we'll see depending on market conditions.
Matt, thank you so much for coming on the show. I think simplicity, focus, conviction is always a good thing, and seems that you're doing great. Thank you.
Thanks, Steffi.